So let me just very briefly welcome everyone to this GTAP virtual seminar series. We are honored to have Professor Peter Dixon with us today to present on this work on financing a global CGE model based on the paper that was published in the Journal of Global Economic Analysis very recently, still warm off the press. I think it was just last month that it was out. In it, there's also an analysis on the effect of financial decoupling between the US and China. My name is Angel Aguiar. I'll be moderating, and I think the only last bit that I would like to share before I ask Peter to take over is that we're talked about having 30 minutes for the presentation, followed by questions and answers. Please do type your questions in the chat box as they occur so that we address them towards the end. And without further ado, Peter, the floor is yours.
Well, thanks, Angel. Yeah, so you got the title slide there. This is joint work. You can see it's based on that paper that's given at the citations given on the bottom of that slide. So it's joint with James Iski, Jason Anasos, and Maureen Rimmer. I'll just say one thing about that paper, which is, I don't often say this about referees and editors, but this was a paper that really benefited from the refereeing and editing process at the Journal of Global Economic Analysis. So it was a credit, I think, to Roberto Rosson and the referees. It was a paper that definitely improved in that process. So thanks to them. Okay, so we go to slide 2. All right, so this is what we did. We added a financial module to an 18-region, 57-commodity version of a GTAP model that had already been extended by having year-on-year dynamics and sticky wage adjustments. That means that in the short run, if you do something good for an economy, there's an increase in employment rather than a change in wages. And then in the longer term, as the labour market tightens up, wages go up. So the long-term benefit of a good policy is in higher wages, and the short-term benefit is in terms of higher employment. And this version of this GTAP model has also got industry-specific capital. So we added the financial module to that version of GTAP, and we applied it to investigate the effects of financial decoupling between the US and China. So go to slide 3. Slide 3. How are we going to slide 3? Yes, here we are. Good, thank you. Okay, so the starting point for this work was Ian Chobachina and McDougall's Global Trust. And we made 3 extensions of the global trust idea. We introduced bilateral relationships. Those of you who are familiar with the global trust know that each country lends money to the global trust and borrows money from the global trust, but there's no direct bilateral relationships. But if we're going to investigate a policy like financial decoupling between a couple of nations that are having sort of an economic war, so we want to have a model that can help us understand the effects of one country discriminating not only in trade but in financial flows, financial relationships against another country. Then we've got to have bilateral relationships. We allowed for funds allocated by region S to region R to then flow to region K. What that means is if China lends money to the US, then the US can take that money and use it to finance capital in the US, or it can lend the money onto third countries. And that's kind of important to make best use of the available data, which refer to holdings by S of financial assets in R, not holdings of physical capital in R. And finally, we specified optimizing rate of return sensitive behavior by financial agents in their decisions on where to place their money. So that replaces the sensible but sort of non-economic idea of how that's in the global trust of how money is allocated between different destinations. All right, so we built the financial module around an 18 region asset liability capital ALC table based on data from the IMF, US and Chinese statistical agencies, and GTAP. So the first question is what is an ALC table? And that's in the next slide, slide 4. All right, here's a 3 region version. So the diagonal components are values of physical capital in each region. So that says that the US capital within the border of the US at the start of 2015, or if you like, the end of 2014, was 53.85 trillion. Then if the off diagonals are values of foreign financial assets in the columns and liabilities in the rows. So the United States had financial assets in China worth 1.14 trillion, looking down that row, all right, or 19.97 trillion in the looking down a column, or 19.97 trillion in the rest of the world. Now, I'm going to struggle a bit on this key idea. This is the most important, controversial theoretical idea. Okay, so we're going to specify a financial agent for each region who allocates the region's financial budget across alternative assets. That is, determines the composition of the region's column in the ALC matrix. Now, this financial agent in the US has a budget, and the budget in 2015, at the beginning of 2015, was $74.96 trillion. That's the column sum there. And where's that budget come from? Well, the agent collects the savings from people in the United States. It collects money from other countries, from the financial agents in other countries. So the financial agents in China and the financial agents of the rest of the world invest funds with the financial agent in the US. And the financial agent in the US can finance, it can use the money to finance the domestic capital, that is let it out to industries, and can send it back to other countries, send it back to China or send it back to the rest of the world. Right? So all the investments in this model are done through these financial agents. Now, what about this financial budget? All right, so that's the next slide, slide 5. All right, so here's the determination of the financial budget. Right, so the financial budget for the agent in country R, at the end of the year, the 1s mean end of year and the 0s mean start of year. So the financial budget at the end of the year for the financial agent in region R is the value of the assets at the beginning of the year. That's the capital stock, that's the VK0, revalued by inflation, that's the VR, plus the foreign assets that region R holds. And that's supplemented during the year by the savings that take place in region R and the amount of money that's borrowed or given to region R by the financial agents in other countries, which is the FL1, that's the foreign liabilities. At the end of the year, take away the foreign liabilities at the start of the year. And you can see there, the idea is to connect to all this financial stuff with standard GTAP, and you can see there that standard GTAP variables are beginning to appear, like save and VK0 and VR are all variables in standard GTAP. Now, Given the financial budget, what does the financial agent in region R actually do? And this is the next slide, slide 6. Right, well, the financial agent, no, slide 6, back one. That's it. Thank you. Well, the financial agent chooses the composition of the assets it's going to hold on behalf of the households and all the in the domestic economy and in the foreign economies and so on. So it chooses the composition of those assets that it's going to hold at the end of the year. That's that Z1SR. So it's choosing the composition of the column of the ALC matrix to maximize the CES function subject to that budget constraint. There's the budget constraint, it's 6. The CES function has got rates of return in it. You see the RSR is the rate of return that financial agent R expects on its investments in region S. Okay, now in percentage change form, that produces the nice little equation 7a on the bottom of that page, which says that the percentage change in region R's holding of assets in S depends on the percentage change in the budget, which depends on how much saving is being done domestically and how much foreigners want to lend to country R.
Oh.
And it depends on a substitution term which compares the rate of returns that are expected on investments in S with average rates of return, averaged over all the destinations that R can have for its financial assets. So that brings us to the question, well, where do these expected rates of return come from? And that's in the next slide, slide 7. All right, so the rate of return that agent R, say the US financial agent, expects on investments in the US is another GTAP variable. That's RORE, R-O-R-E, which is the expected rate of return on physical capital in region R. And the rate of return that the financial agent in the US expects on its investments in region S. That depends on the rate of return, the average rate of return that's expected on the portfolio of investments by the agent in region in S. Remember that when region R sends funds to region S, it does so through the financial agent in region S. Thus, the rate of return that R expects on these funds reflects the expected rate of return on the portfolio managed by the agent in S. Now, that equation 9 has got one more variable in it, which is that TSR on the end, which we can use that variable in simulating financial decoupling. So if we want to simulate a policy that reduces the ability of the US to invest in China, or the ability of China to invest in the US, we can do that by negative shocks to the variable called TSR. So a reduction in TSR reduces the rate of return that agent R expects on its investments in region S. Okay, so the last bit of the theory is on in slide 8, which is about foreign income flows. So we go to slide 8. We've got to collect up receipts that country R gets on its foreign assets, and that depends on the composition of those foreign assets, which is that Z0SR, and it depends on how much assets in country S earn per unit of asset, and that's that CRS. Now, and then the next equation 13 gives the payments on foreign liabilities by country R, and those CRs, which are the income flows per unit of investment well, CRS is the income flow per unit of investment in country S. Those income flows are dominated by the variable NRS, which is the net rental on capital in region S. And that's, again, another connection with standard GTAP. That's a variable that comes out of standard GTAP. And then last of all, we include the difference between the receipts and the payments that are made by R's net national product, which is income in GTAP notation. So all these connections with the standard GTAP model. All right, now we go to the application, which is slide 9. All right, so we're going to do 3 simulations. So this is all to do with US-China financial decoupling, which was a possibility that was being discussed in 2019 and 2020. And actually, we commissioned to do this work. So it was a relevant policy idea. So the first simulation is the US cuts assets entrusted to China by 50%, and we do that by exogenizing the path of Z1, that's the end of year holdings, by the US in China, Z1, China, US, and endogenizing the path of that T variable. So we tell the model what's going to happen to US holdings of assets in China, and let the model tell us what has to happen to that T variable, what has to happen to the expected rates of return for US investors in China. And then simulation 2 is the opposite way around. China cuts assets entrusted to the US by 50%. And simulation 3 is both things happen simultaneously. They both cut their financial assets in each other by 50%. Now, the simulation, all these 50% cuts are conducted relative to a baseline. So there's a fairly bland baseline that goes out to 2025, and the cuts are phased in over 3 years, which are 2016, 2017, and 2018. Okay, so we look at some results, slide 10. Okay, now this is simulation 1. This table might take a moment to get used to. Okay, you can see the exogenous shock, which is the US as an asset agent. Asset agent is in the columns. So the US as an asset agent in 2016 reduces its financial assets in China by 20.63%. Then by 2017, the reduction is 37%. By 2018, it's 50%, and then it's held at 50%. Right, so there's a reduction in US assets in China phased in over 3 years. Now, what does that do? Well, it causes the US to redirect funds towards domestic capital, and you can see that by 2025, US domestic, that's, if you look at concentrated 2025, that's the panel on the far right there. So the US directs funds towards domestic capital, and you can see by 2025 that US capital is 0.3% higher than it otherwise would have been. And looking down that column, the US column in 2025, you can see that rest of world US investments in the rest of the world are at 0.86% higher than they otherwise would have been. And US wealth is increased by 0.14%, and that reflects favourable macro effects, which we'll discuss in a moment. Now, for China, look at 2025 again. China's financial budget has been reduced. Okay, it hasn't got the money from the United States, so China's financial budget is reduced, leading to reduced reduced domestic capital and foreign assets. So look down that China column in 2025, it's all negative. And Chinese wealth decreases by 0.17% in 2025, reflecting unfavourable macro effects. Now, what are these favourable and unfavourable macro effects? Well, that's in slide 11. Next slide. Slide 11. Here we go. So, well, the US winds up with more physical capital because of the money being brought back to the US. So that's in the third, in panel C there. So you can see the US capital is up by 0.20%, and the Chinese capital is down by 0.39. That allows the US GDP to be up. You can see the 0.06 in the top panel there, and China's GDP is down. The process of building up capital is good for employment in the short run, and you can see US employment rises. That's the blue line in the middle panel with the sticky wage assumption, and then the labour market adjusts and wages are permanently higher in the US, and employment returns to control, and the opposite for China. All right, so we look at the next slide, slide 12. Yep, that's the one. Okay, now this is the do we take a question? Someone wants to ask me a question, I think. Okay, perhaps make the questions at the end, I think. Okay, so so in simulation 2, China cuts assets entrusted to the US by 50%. So it's kind of opposite. So these results show that the reduction in Chinese assets in the US, it's phased in over 3 years. China redirects funds towards domestic capital. Look at the panel on the right. You can see that capital in China rises by 1.81%. In 2025. Chinese investments in the rest of the world are up by 7.68%. Chinese wealth increases 0.62%, reflecting favourable macro effects. The US financial budget is reduced, leading to reduced domestic capital and foreign assets, and US wealth decreases. So you can see that's down by 0.72% in 2025, reflecting unfavourable macro effects. And then go to slide 13, and you can see that slide 13, those macro effects, look at slide 13, we can see that those macro effects are qualitatively just the opposite of the macro effects in simulation 1. China's capital is up, China's GDP is up, China experiences a short-run favourable employment effect and long-run favourable wage effects, and for the United States, it's exactly the opposite. Now, slide 14. Okay, now, if you're able to follow all those numbers, I'm saying you would be able to. These presentations are always difficult with lots of numbers, but you might have noticed that simulation 2 looks like a lot bigger than simulation 1. So we'll ask this question: why is the capital effect in China of withdrawal from the US, that's simulation 2, 6 times greater than the capital effect in the US of withdrawal from China, that's simulation 1? So let's look at that. Those numbers there, you can see that in simulation 1, which was good for the US capital stock was up by 0.3. In simulation 2, which was good for China, Chinese capital stock is up by 6 times more, that's 1.81. And there are 2 reasons. One reason is that the impact effect is 4 times bigger for China in simulation 2 than for the US. What do I mean by that? Well, China has a lot more money in the US than the US has in China, right? So we withdrew 50%. So China is bringing back a lot more money to China in simulation 2 than the US was bringing back to the US in simulation 1. That's one thing. And then the other point is that on this impact effect is that China's capital stock is smaller than the US capital stock. So in percentage terms, Simulation 2 is doing a lot more for China than Simulation 1 is doing for the US. But that only really explained a 4 times bigger effect, and the answer is 6 times bigger. So we look for the other part. And this turned out to be quite interesting. It's all to do with the US financial markets are a good deal more open than China's. So when the US brings back money, if you like, from China, US financial agents have much more opportunity to send it on to third countries. So less of it stays in the US. And similarly, when the US brings back money from China and invests more in the US, thereby reducing rates of return on capital in the US, this openness means that foreigners, third country foreigners, withdraw their money from the US. So the US gains a good deal less in terms of domestic capital stock from bringing back money than the other way around. So now, implication. Now we know that China wins in simulation 2. Sorry, China wins in simulation 2, and simulation 2 is a much bigger, quantitatively bigger thing than simulation 1. So China wins in simulation 2, the US wins in simulation 1. Put those things together in simulation 3, and you'd expect China to be the winner. All right, and that's confirmed in slide 15. So we go to slide 15. There we are. That's simulation 3, 50% financial decoupling by both the US and China. And so China winds up with more capital, the US winds up with less capital, China winds up with more GDP, US with less GDP. China has a short-run temporary employment gain, and the US has a temporary employment loss. Okay, so I think we're nearly there. So let's go to slide 16. Okay. Now, in terms of macro effects, a 50% financial decoupling is just as important to the effects on GDP and capital and wages and employment and so on, are just as important as a 50% trade decoupling. But both countries lose in tit-for-tat trade decoupling. That's a bit different. You see, in tit-for-tat financial decoupling, there were winners and losers, but in tit-for-tat trade decoupling, where both countries impose tariffs against each other or inhibit imports in some other way, both countries turn out to be losers. Now, if we add trade decoupling to financial decoupling, well then the trade decoupling more or less completely wipes out the gains that China got from financial decoupling. So you can see in that diagram, China's basically reduced to, well, that's the GDP effect. China's more or less reduced to zero GDP effect. Financial decoupling hurt the United States, and trade decoupling hurts it more, and so you can see that the United States winds up fairly far down the page. That's the GDP effect, but all the other effects are pretty much the same as you'd expect. Okay, so that brings me to what's to be done next, and that's the next slide. So this area is for future development. There's obviously a lot more data work. There's always more data work to be done, and it's pretty hard to find clients who've got enough patience and money for data work, but there's always more to be done. All this analysis depends pretty much on the ALC tables, the asset liability capital tables, and we worked very hard on the US-China corner of the tables, and we got control totals on foreign assets and liabilities from the IMF, and we filled in most of the rest of the table by RAS, which means that while we're reasonably comfortable with what we're saying about China and the US, the model is not really suitable at the moment to extend to third countries, other countries, right? So more work's going to be needed there. Now, another area which Jason Nasios is working on, which is very important, I think, is disaggregation of the financial instruments into loans, bonds, equity, cash, special drawing rights. And that's a direction that the COPS team's been taking their single country models, right? And once in those single country models, but it would be wonderful to do it in its GTAP framework. But in the single country models, we can at last, in a general equilibrium modeling, start saying something sensible and understanding things about monetary policy. And then another area which we've been investigating in our single country models is recognition of multiple financial agents for each country. So in this modeling, we just had the one financial agent, but we need multiple financial agents in each country, which is the financial agents that are making financial decisions, households, banks, non-bank financial institutions, retirement funds, industries, and government. And in terms of the application that we've just gone through, once we had multiple financial agents, then we could take account of the idea that the Chinese, when they invest in the United States, buy mainly bonds, financial instruments like that. And the United States, when it invests in China, does a lot more FDI, invests in actual industries. So once you had multiple financial agents, that's the sort of direction that the work we're doing could be extended. Okay, I think that brings me to the end. So we've got time for questions. Okay, thanks. So thank you.
Thank you, Peter. Yes, there was a question in the chat by Madan Mohan Ghosh, and yes, round of applause, Peter. Very enlightening. I know you went really quickly over this, but it's still very, very nice presentation. Thank you. And I just let me jump into the questions because allowing more folks to ask as well. What is driving the results? Is it the marginal productivity of capital and imperfect capital market? But Madan Mohan Ghosh.
Okay. All right. So what's driving the results is when the United States invests less in China, right, then there's more money to be invested in other assets. So the United States financial agent is pretty biased towards investing in the United States. So there's a home bias. So the United States financial asset finances more capital projects in the United States, which reduces rates of return that are required on investments in the United States. And then that causes the financial agents in the United States to reconfigure and invest in other countries. So you can see there's if the United States can't invest in China, there's a reconfiguration of the United States budget towards its own assets and towards assets in the rest of the world. And that reconfigures rates of return all over the world and causes all the financial agents in the world to reconfigure their budgets, so their investments. So what drives the results are these rates of return, which drive physical investment, which drives employment and wage rates and all of the things that you'd expect to happen in the general equilibrium model. So I hope that helps. We've done a lot of work in the paper on back of the envelope explanations of where all the results come from.
Peter, I had a question on the whether the crafting of the baseline on those earlier years from 2014 to say 2019 would be helpful to calibrate sigma, the elasticity of substitution?
Yeah. Okay, so that's so. All right. So what we actually know are all those shares. So we've got a pretty good handle on what the financial budgets, how they've been allocated by the countries. Right. So there's one of the good things about so much financial regulation is that it generates quite good data. Right. Okay, but sigma, that's substitution elasticity, the sensitivity of the allocation of the budgets between different destinations, the sensitivity of that to change in expected rates of return, we know very little about that. Right? Now, presumably it could, people who know a lot more about econometrics than I do, maybe they could start trying to estimate it, but it looks like a pretty difficult job. So what we did was we did sensitivity analysis. So in the paper, we vary that sigma between, I forget, we took it from 1 to 5 or something. I mean, we varied it across quite a big range. And sure, the results depend on that sigma, but qualitatively, all the things that I said about the results stand up pretty well to variations in that sigma. You don't want to make the sigma too low because then the allocations will be more rigid than we think is realistic, and you don't want to make it too high, otherwise they'd be too volatile, the allocations. So the sigma in the range of about 3 seemed to, in my intuition, but it's only my intuition, seemed to be about right. But fortunately, the results were reasonably robust to variations in that sigma.
And then the other, well, there's there's another question. I'll save mine for later. It's actually, let me open this. All right. So Charles mentions, thanks for the presentation, Professor. I have a couple of questions. Does the model automatically handle balance of payments? What is the implication on exchange rates? For example, will China withdrawing money from the US create a decline in exchange rates and boost US net exports? No expectation is introduced to the model, right? Best, Charles.
Okay, I should declare that Charles was my very distinguished student, so thanks, Charles, for that. And also wrote about financial, his thesis, a very good thesis about financial modelling. Okay, balance of payments. Everything that's done in GTAP carries through, right? So if when the United States brings back money from China and reduces required rates of return in the United States and stimulates investment in the United States, the balance of payments moves towards deficit, as you'd expect. Okay, so all those mechanisms about the balance of payments and the relationship between investment and saving, the balance of payments, all of that goes through, and you can you remember the monetary, the income flows are all taken care of too. One of the slides went through the income flows, and they all feed into the balance of payments. Exchange rates, that's a tricky one. The exchange rates, there's no nominal exchange rates. Okay, so if we so the real exchange rates are determined in the model. So when a country does more investment, its real exchange rate, its price level real exchange rate appreciates. So when the US brings back money from China, its real exchange rate, its price level relative to the price level of the rest of the world goes up. But there's no nominal exchange rates being recognised or movements in nominal exchange rates, and that would be a direction that we should go if we can make if we can bring in more of these monetary instruments into this international model. In our single country models, we do the exchange rate and the breakdown between movements in the exchange rate and movements in the price level in determining the movement in the real exchange rate. So there's something for you to do, Charles. Give it a go. All right. Okay, next.
There's a question about whether the results of the 2015 to 2019 match with real data. So I suppose this is related to the baseline.
Yeah, that's the baseline is broadly right. Okay. We cunningly stopped, of course, at 2019 because things get difficult by 2020. So the baseline the baseline is right at the macro level. Okay, it's not necessarily right at the industry levels, but it's roughly right at the macro level. But it's a pretty bland baseline. Of course, in another project, we're taking that validation, whether things are right or wrong, we're taking that validation very seriously. We're actually trying to move, say, from 2004 to 2014, and then 2000, and work out what happened to technologies and what happened to consumer preferences and what happened to required rates of return on investment and so on in an historical period, and then introduce trends in all those variables into the baseline and see if we can make the baselines gel more closely, not just at a macro level but at an industry level with the data. But no, the baseline in this exercise was pretty bland and just broadly right at the macro level.
Thank you, Peter. I think this is a long one, so please bear with me. Thank you for the very interesting presentation. For these large capital flows, how would these relate to typical shocks seen in a central bank type macro model? In those models, capital flows respond to changes in asset prices. These are affected by quantitative easing, monetary policy, and shocks to the risk premium, among others. I am thinking of the most recent prominent example of tapering of quantitative easing in the US and caused large capital outflows. This was a monetary policy action. Does this model try to replicate these types of policy-driven dynamics? Also related to the last question, capital flows should respond to asset price changes, and these necessarily change exchange rates. Are exchange rates important in the simulations? In macro models, these would drive results, particularly for trade.
Yeah, that's a hard one. All right, so I can do tiny bits of that. A lot of that is actually done in our single country models. Okay, and there are references to papers by Jason Nasios and James Skiski and colleagues, right? So all sorts of interesting things in those papers about how if the government dictates that retirement funds, that we to have more money in retirement funds, how that changes capital flows and whatever. Now, one of the many weaknesses of this thing that I've just presented was that there aren't any nominal exchange rate changes. So there was no valuation effects on foreign assets and foreign liabilities, right? So until the model gets some movements or some modeling of nominal exchange rates, a lot of the rest of that stuff just can't be done in this model. Now, on quantitative easing and so on, well, I'm just talking off the top of my head now, but I think we could do something about that. I think that affects those financial budgets. So I think we could relate quantitative easing to the financial budgets and then simulate changes in the financial budgets, but it's very much off the top of my head. So, yeah. So I think I better move on to another question, and before I get into more trouble on that one. Okay.
Yeah, well, we don't have one. We got a thank you very much, and I also want to thank you, Peter. I think we're also reaching the end of the period, and I think rather than taking another lengthy question, I'll just say thanks again for taking the time to stop it by. Thank you all for the excellent questions, and maybe we can just uh, wish you a great day in Australia, and hopefully for good more tennis results as well.
Okay, well, thank you very much, and thank you for inviting me. And if anyone wants to send me a question about something, or some comments or suggestions for further research, or tell me that something's already been done, or I should be looking at something or other, please do. All right. Okay, so thank you very much.
Thank you. And so there's a question about presentation being available. It will be available on the website as long with this recording as well. And the paper, of course, is available in the Journal of Global Economic Analysis with supplementary materials so that you guys can replicate these as well, the results and the figures. So thank you very much, Peter.
All right, thank you. Right,
Good to
bye.
see you. Bye.